You know, when I said this is the best year ever again, I really meant it. This year, 2019, we increased distributions on 19 different properties, which is 62% of our 32 partnerships. Not only did you increase the most numbers of partnerships, but the biggest dollars ever are being distributed right now. And those of you who are lucky enough to be in the leads, for instance, a property bought at the bottom of the market by Pat Riley in April of 2009, you've gotten back 2.25 times your original investment in cash, and then the cash flow has gone from 8% to 18% per year, which is a very nice number because I am one of the biggest investors in these partnerships, so it helps me a lot. You know, it's good to invest in your own deals, man. That's how it works. We always make money. The reserves, another property in Rancho Cordova, we owned that since 1995. The cash flow on that property is now at 25% per year. The investment's worth 5.3 times what the investors invested into it back in 1995. So we've had a great run. So how do we increase these cash flows? Obviously, it's part of management and location, but we're putting loans on only interest-only loans on these properties, on these refinancing of these properties. You know, like most of you probably are buying your homes, you're amortizing your loans. Well, part of the loan payment is going to pay down that loan. I don't like that at all. I would rather have interest only, and you and I as investors getting the cash flow, not the lender. So I'm sorry, Wells Fargo, you're right here. We don't only interest-only loans on acquisition and refinances. We also do green loans, which is the right thing to do. We put together programs to save energy, LED lighting. We lower water use from low floater shower heads and toilets. So it's the right thing to do, and these programs are there, and we take advantage of them. So how does this all happen? Well, I'm going to have Pat Riley talk about buying right in a minute, and managing well with Bill Brooks. Those two are critically important, but my idea was to have a superior positive leverage financial structure. So basically, when we buy properties, we'll put 65% down from the lender, typically, and we'll borrow then 10% from you and I as investors out there. So we get 75% leverage. So if you invest $250,000, you're really investing $1 million. So you're getting a lot more money working for you in the investment. And if you look at the competition out there, which I've spent a lot of time evaluating, they only typically leverage 50%. So you give them $250,000, you only have $500,000 working for you. With a Coit Sequoia, you got $1 million working for you. Does that work? Let's talk about an example we sold this year. We sold San Marquis, a property in Tempe, Arizona, our 28th sale. Investors who put $100,000 in that investment have gotten back in about 5.5 years, $244,000. It's like $34,000 of cash flow, and almost more than doubled their invested dollars. So the rate of return per year to the investors, 17.11% per year compounded. Again, key word here, compounded. Most other advisors just talk about simple interest rate of return per year. That's totally bogus. You want to know what the IRR is, compound rate of return per year. You know, if you look at the stock market, the S&P 500 in the same period of time, 5.5 years, made 10.1%. So our investments made 70% better than the stock market in the same time frame. And I also thoroughly believe that we do it with a lot less risk to you as an investor. For instance, on Shore Park, we could be 25% vacant in that property and it still breaks even. I really wonder how much risk we're taking on Shore Park. Yeah, not a lot in my opinion. We've sold 28 properties to date. Our median return has been 14% compounded rate of return per year. In the same time frame as the stock market, they made about 9.7%. So again, I like to compete. I like to compete against the stock market and other real estate people and kick their butt. I'd like to make more money for you as investors. Let's talk about cycle performance. The real key about making money in apartment real estate or any kind of real estate is increasing the income from the property, increasing the net operating income. So it's income minus expenses equals your net operating income. Well, Lisa Trapp did the numbers for me on this. On 21 properties from 2010 through 2018, we're able to increase the net operating income by over 61%, an incredible number of $33 million. So if you take a cap rate of 4.5%, which is a pretty good sale number, which we probably do better most of the time, it increased the value on those 21 properties by $740 million. I mean, it's like $750 million of increased value on those 21 properties over 8 years. Now, it's been a great eight-year run. I don't think we're going to do that well, those kinds of numbers on a go-forward basis, but we will certainly do better than, in my opinion, anybody else who we compete against or the stock market, and do it with a lot less risk. Our performance strategy is pretty straightforward. One, it's long-term, 7 to 10 years. We buy only on the West Coast. We don't buy in Ohio or Wisconsin or Texas. We buy where there's a lot of jobs being created. We buy properties around technology-driven companies. We buy properties which are located ideally near rapid transit. We bought 2 properties last year, one in Walnut Creek, had a walk score rating of 91. Bought a property in Concord. It was directly across the street from BART, downtown Concord. We try to buy where there are better schools, because obviously if you're a renter, you want your kids to have the best schools, and you're willing to pay a bit extra for that. We know that, so we renovate the units. Then we try to buy properties where the family income is higher. On Shore Park, for instance, that's in a pocket part of Sacramento. The median income there is like $93,000. It's just Shore Park's going to do quite well. And the third thing, and most important thing, I think, on our performance strategy is a value add. And when I say value add, we invest into the property $15,000. We typically try to get a 12% return on that investment, so that means we increase the rent ideally by $150. So we're on a $15,000 investment. We're getting a cash-on-cash return of 12, which is really great. I mean, that's our goal. But the real important thing is how much you increase the value of that property. Again, using a 4.5 cap rate, divide 4.5 into the 1,800, it increases the value of the property, that one unit, by $40,000. Well, you run that on 300 units or 150 units, the numbers become quite amazing, and it goes back to how we create wealth for all of us as investors. Kind of summarize it up. I mean, you know, all of us live in a time right now where the news is really not too great. We got political challenges, we got trade issues, we got global slowdown, we got impending recession. Well, quite candidly, I don't worry about that from an investment perspective. I just want to invest in multifamily, because multifamily typically will succeed in just about any economy. Multifamily is the lowest risk asset class in all of real estate. And the reason is you never, ever, ever get 25 or 50% vacant with an apartment. You just don't do that. If you have a weak economy, all you have to do is just start lowering the rents to a certain degree to get it filled up. And I'll give you an example why. I have not bought an apartment, I have not bought a R&D building or office building or a shopping center since 1988. Because 1988, this is before I was a general partner, we bought an R&D building in San Jose. In 60 days after we closed escrow, the lead business went bankrupt. We were 50 vacant after 60 days. That's not a good deal. That was very painful. But I had to hire an attorney or two to have a discussion with the errant general partner to get the point across that he screwed up, and so he is going to pay a real high price unless we can fix this problem. You know what? It's amazing what happened when this was brought up to him. It got fixed, and those dollars subsequently went into Post Street Towers, Tower 737, which is my best real estate investment to date. And I think the last thing is that the interest rates that we're getting right now are absolutely unbelievably low. It is wonderful to be in this business today. On Shalco, we borrowed money for 10 years interest only at 3.72. Altaloma, we borrowed money for 10 years interest only at 3.52. And on Shore Park, I can't believe borrowed so cheap. We borrowed money at 3.37 fixed for 10 years. I mean, how much risk are we taking on those investments? And all of them start out at a 5% cash on cash flow. My God, what a wonderful time to be investing today. That's why I don't retire. So I'm very bullish on the future of what we have in place. I'm very bullish on a go-forward basis. I think we got one heck of a team built up here with Sequoia and myself, and I think it's only going to get better. And that's end of my short talk.